Good morning to all of you. Today in MBA fourth semester, we are going to deal the topic related to the subject that is strategic management. Okay, on that we are going to deal with the very important topic of the fifth unit, and that is analyzing variance. Okay, it is what if we talk about the analyzing variance, then it is the quantitative investigation of the difference between actual and planned behavior. Okay, it is used to maintain control over a business, whatever the business which we are dealing with, and this is being used. Variance analysis is only being used to know or to control the variances which occurs between the set standards and the actual performance which comes. For example, if the budget for sales to be rupees 10,000 and actual sales are of rupees 8,000, then the difference of variance analysis is of around 2,000. Why this 2,000 comes? Why there? What are those factors? What are those reasons? What are those causes on the basis of which the difference comes? That study, that analysis is known as variance analysis. Okay, so in this variance analysis, in strategic control and evaluation part, it is very much necessary that we have to study about the variances. Okay, and variances are only being studied with the help of analysis, which we are going to do, which we are going to deal with the analyzing while analyzing the variances in various perspectives, in various aspects of the business. Most, as we know, that few of the commonly derived variances used in variance analysis are: number one, that is purchase price variance. Okay, here we are going to study about few of the variances, common and general variances, which is being prevalent in the field of management, where most of the management activities, where most of the managers used to deal with those variances part and try to come up with the causes or the reasons, that what are the causes, what are those reasons on the basis of which the variances has come up. Okay, so the very first is purchase price variance. Okay, if we talk about this purchase price variance, then it is the actual price paid for material used in the production process minus the standard cost multiplied by the number of unit cost. Okay, so this is calculated, this variance, purchase price variance is being calculated by this, where we can use the formula, that is purchase price variance equals to actual price minus standard price. First of all, we have to deduct the actual price with the standard price, and we have to multiply the actual quantity, that whatever the quantity is being dealt, that is multiplied with that. On that basis, the purchase price variance comes. Okay, this is what, if we talk about the standard, here the term standard price comes. Actual price means what? The price on which actually it is being sold, that is known as what? Actual price. And if we talk about the standard price, then what is that? The standard price is the price that engineers believe the company should pay for an item given a certain quantity level, purchasing quantity and speed of delivery. That is known as what? A standard price. The next variance analysis is labor rate variance. What is that? Labor is a very important factor, and for that purpose also the variances, we have to calculate the variance in the company. That is the actual price paid for the direct labor used in the production process minus its standard cost multiplied by the number of actual hours worked. The formula is labor rate variance equals to actual rate minus standard rate into actual hours worked. So by this formula we are going to calculate the labor rate variance. The third one is what? Variable overhead spending variance. Very important, that is variable overhead spending variance. That overhead means extra which we are going to expend. Okay, that variance which comes, that we are going to deal with. It is the difference between the actual and budgeted rate of spending on variable overhead. Okay, so the formula of variable overhead spending variance equals to actual hours worked into actual overhead rate minus standard overhead rate. Okay, the fourth important variance analysis is fixed overhead spending variance. What is that? Fixed overhead spending variance. It is what? It is the difference between the actual fixed overhead expenses incurred and the budgeted fixed overhead expenses. The formula is fixed overhead spending variance equals to actual fixed overhead minus budgeted fixed overhead. Okay. Fifth one is selling price variance. So this selling price variance is a very important variance analysis where we are going to get the difference of the selling prices. Okay, it is the difference between the actual and expected revenue that is caused by a change in the price of a product or service. Here selling price variance equals to actual price minus budgeted price into actual unit sales. Okay, and the sixth important, very important variance analysis is related with the labor efficiency variance. Okay, here we are going to calculate the efficiency of the labor. That how does the efficiency of the labor is being calculated related to the standard and the actual efficiency of the labor. So it is being here we are going to subtract the standard quantity of labor consumed from the actual amount and multiply the remainder by the standard labor rate per hour. Okay, so here the formula is labor efficiency variance equals to actual hours minus standard hours into standard rate. Okay, so students, with this we can say that the variable analysis, okay, a variance analysis is a very important factor which helps the company, which helps the manager to calculate the variances of the standard and the actual performance which is being held, and accordingly we can come to know and after calculating that we can come to know the differences, and those differences which comes, we are going to calculate those differences, and accordingly we are going to do what? Whatever the differences would come, we are going to study those differences. We are going to do research on differences. We have to find out the factors. We have to find out the causes of effect, that what are those causes which brings the variances or variability in the standard and actual performance, and accordingly we take the solutions, and accordingly we control the strategies as well as the operations of the organization. So this is a very important mathematical calculation where the manager should have to know with these formulas which I have discussed, related to the purchase price variance, related to the labor rate variance, related to the variable overhead spending variance, related to the fixed overhead spending variance, related to the selling price variance, and related to the labor efficiency variance. So these are what? These are different types of 6 variables which the company should have to calculate so that they can know the different types of variabilities or variances which comes between the standard and the actual performances, and accordingly they take actions, they choose the solutions. Okay students, thank you to all of you.